Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the Letter of Credit LC Part 9. Hope you will like, share and special request to all to don't forget to subscribe our channel. Letter of Credit LC Part 9, a brief explanation of trade terms. General Incoterms. The Incoterms or International Commercial Terms are a series of predefined commercial terms published by the International Chamber of Commerce (ICC) relating to international commercial law. Incoterms defines the responsibilities of exporters and importers in the arrangement of shipments and the transfer of liability involved at various stages of the transaction. They are widely used in international commercial transactions or procurement processes, and their use is encouraged by trade councils, courts, and international lawyers. A series of three-letter trade terms related to common contractual sales practices. The Incoterms rules are intended primarily to clearly communicate the task, costs and risks associated or involved with the global or international transportation and delivery of goods. Incoterms inform sales contracts defining respective obligations, costs and risks involved in the delivery of goods from the seller to the buyer, but they do not themselves conclude a contract, determine the price payable, currency or credit terms, govern contract law, or define where title to goods transfers. The Incoterms rules are accepted by governments, legal authorities, and practitioners worldwide for the interpretation of most commonly used terms in international trade. They are intended to reduce or remove altogether uncertainties arising from the different interpretation of the rules in different countries. As such, they are regularly incorporated into sales contracts worldwide. Incoterms is a registered trademark of the ICC. General Incoterms EXW X works. The seller makes the goods available at their premises or at another named place. The This term places the maximum obligation on the buyer and the minimum obligation on the seller. The ex works term is often used while making an initial quotation for the sale of goods without any costs included. EXW means that a buyer incurs the risk of bringing the goods to their final destination. Either the seller does not load the goods on collecting vehicles and does not clear them for export, or if the seller does load the goods, they do so at the buyer's risks and costs. If the parties agrees that the seller should be responsible for the loading of the goods on departure and to bear the risk and all costs of such loading, this must be made clear by adding explicit wording to this effect in the contract of sale. There is no obligation for the seller to make a contract of carriage, but there is also no obligation for the buyer to arrange one either. The buyer may sell the goods on to their own customer for collection from the original seller's warehouse. However, in common practice, the buyer arranges the collection of the freight from the designated location and is responsible for clearing the goods through customs. The buyer is also responsible for completing all the export documentation. Although the seller does have an obligation to obtain information and documents at the buyer's request and cost. EXW, that is Xworks, is generally used for internal LC and not for export or import LC. CIF. The term cost insurance freight or CIF predates the introduction of Incoterms, or Craig Hall noted in a 1919 article that in earlier times the initials were usually written CF and I. He quotes the phrase "CF&I by steamer to N.Y" used in a shipping contract addressed in the New York State case of Me v. McNider in 1886. In simple words, CIF means cost, insurance, and freight to the named port of destination. The seller loads the goods on board at the port of shipment at his expense, repairs the freight and cost of marine insurance, and supplies the buyer with a negotiable marine insurance policy and a clean negotiable on-board ocean bill of lading. CFR. Cost and freight to the named port of destination. The seller loads the goods on board the carrying vessel at his expense, prepares the freight, and supplies the buyer with a clean negotiable on-board ocean bill of lading. Insurance of the goods is the buyer's responsibility. This is the only difference between CIF and CFR. DAP. Incoterms 2010 or 2010 defines DAP as delivered at place. The seller delivers when the goods are placed at the disposal of the buyer on the arriving means of transport ready for unloading at the named place of destination. Under DAP terms, the risk passes from the seller to the buyer from the point of destination mentioned in the contract of delivery. Once goods are ready for shipment, the necessary packing is carried out by the seller at their own cost so that the goods reach their final destination safely. All necessary legal formalities in the exporting country are completed by the seller at their own cost and risk to clear the goods for export. After arrival of the goods in the country of destination, the custom clearance in the importing country needs to be completed by the buyer. Example, import permit, documents required by customs, etc., including all customs duties and taxes. FOB. Free on board to the named port of shipment. The seller delivers the goods on board the carrying vessel and bears all cost and risk until goods pass over the ship's rail. The seller supplies the buyer with a clean negotiable on-board bill of lading. The buyer is responsible for the payment of freight and insurance. FAS. Free alongside ship. The seller delivers the goods alongside the vessel at the loading berth named by the buyer. At this point, the seller obligations are fulfilled. This means the buyer bears all costs and risks of loss or damage to the goods from that moment. Unlike FOB, this term requires the buyer to clear the goods for export and pay loading costs in addition to freight and insurance. DAP. Incoterms 2010 defines DAP as delivered at place. The seller delivers the goods when the goods are placed at the disposal of the buyer on the arriving means of transport ready for unloading at the named place of destination. Under DAP terms, the risks pass from the seller to the buyer from the point of destination mentioned in the contract of delivery. Once the goods are ready for shipment, the necessary packing is carried out by the seller at their own cost so that the goods reaches the final destination safely. All necessary legal formalities in the exporting country are completed by the seller at their own risk and to clear the goods for export. After arrival of the goods in the country of destination, the custom clearance in the importing country needs to be completed by the buyer. For example, import permit documents required by customs, etc., including all customs duties and taxes. Under DAP terms, all carriage expenses with any terminal expenses are paid by the seller up to the agreed destination point. The necessary unloading cost of at final destination has to be borne by the buyer under DAP terms. CPT. CPT replaces the C&F and CFR for all shipping modes outside of non-containerized sea traffic. Freight. The seller pays for the carriage of the goods up to the named place of destination. However, the goods are considered to be delivered when the goods have been handed over to the first or main carrier so that the risk transferred to buyer upon handing over to that carrier at the place of shipment in the country of export. The seller is responsible for origin costs including export clearance and freight costs for carriage to the main named place of destination, either the final destination such as the buyer's facilities or a port of destination. This has to be agreed to by the seller and buyer, however. CIP. This term is broadly similar to the above CPT term with the exception that the seller is required to obtain insurance for the goods while in transit. CIP requires the seller to insure the goods for 110% of the contract value under Institute Cargo Clauses A of the Institute of London Underwriters, which is a change from Incoterms 2010, where the minimum was Institute Cargo Clause C, or any similar set of clauses unless specifically agreed by both parties. The policy should be in the same currency as in the contract and should allow the buyer, the seller, and anyone else with an insurable interest in the goods to be able to make a claim. DIP. This Incoterm requires that the seller delivers the goods unloaded at the named place of destination. The seller covers all the cost of transport, export fees, carriage, unloading from main carrier at destination port and destination port charges, and assumes all risk until arrival at the destination port or terminal. The terminal can be a port, airport, or inland freight interchange, but must be a facility with the capability to receive the shipment. If the seller is not able to organize unloading, they should consider shipping under DAP terms instead. All charges after unloading, for example, import duty, taxes, customs, and on carriage, are to be borne by the buyer. However, any delay or demurrage charges at the terminal will be generally for the seller's account. After arrival of the goods in the country of destination, the customs clearance in the importing country needs to be completed by the buyer. For example, import permit, documents required by custom, etc., including all customs duties and taxes. DDP: Seller is responsible for delivering the goods to the named place in the country of the buyer and pays all costs in bringing the goods to the destination, including import duties and taxes. The seller is not responsible for unloading. This term is often used in place of the Incoterm free in store. This term places the maximum obligation on the seller and the minimum obligation on the buyer. No risk or responsibility is transferred to the buyer until delivery of the goods at the named place of destination. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel, Accounts and Finance with FARSK. Thank you. Have a great day.